Imagine leaving behind not just wealth, but clarity, confidence, and security for your family. This is what a properly built estate plan does. Too many Canadians leave their estate to chance, only to have their families face tax penalties, probate delays, and avoidable stress. At Safe Pacific, we can help you structure your estate to transfer your assets efficiently, reduce your taxes, and keep your legacy intact. Hi, my name is Laurent Munier. I'm a partner and advisor here at Safe Pacific Financial, and in today's video, we'll break down the essential steps to create an estate plan that protects your wealth and the people that you love. So why does estate planning matter for high-income Canadians? Estate planning in Canada goes far beyond just drafting a will. So for high-income professionals or incorporated business owners and successful real estate investors, estate planning is a critical strategy to protect your wealth, to minimize your tax exposure, and to ensure a smooth and stress-free transfer of your assets to the next generation. Without proper planning, your estate can become vulnerable to several avoidable complications. For example, most Canadians don't realize that when they pass away, their assets could be subject to probate, which is a legal process that can take months or years to resolve. During probate, your financial affairs become public record, and your beneficiaries could face delays accessing funds. Your estate can also incur significant probate fees depending on the province you live in. Worse yet, your corporate shares, your investment portfolio, your appreciated real estate holdings like a rental property or a cottage, they can trigger a deemed disposition, which means that the CRA treats it as if it was sold the day before you died. So this results in a capital gains tax bill that your heirs must pay, and sometimes forcing the sale of valuable family assets just to cover taxes. So on top of that, if your intentions aren't clearly spelled out with the right legal and financial structures in place, your loved ones may face disputes over the estate. They could have strained family dynamics and unnecessary emotional hardship. And that's why for all Canadians, affluent and not, estate planning isn't optional, it's essential. And that's why we're here. I'm going to give you a couple steps to improve your estate plan right now. Step 1 is to create a legally binding will. This is the foundation of your estate plan. So creating a legally binding will is the first and most important essential step in protecting your wealth and ensuring your legacy is preserved. So for high-income Canadians, especially for business owners or incorporated professionals, and real estate investors actually is really big, your will isn't just a piece of paper. It's a powerful legal document that determines how your assets will be distributed, who's going to manage the estate, and who's going to care for your dependents after you're gone. Despite the importance, there's surveys that show that over half of Canadians either don't have a will or have one that's outdated or invalid. So this can lead to delays, it can lead to legal challenges, unnecessary taxation, all of which are preventable with proper planning. The will serves a few critical functions. So it names the executor. That's a big one. This is the person who's going to carry out your wishes and to manage the estate process. It specifies your beneficiaries. So this will ensure that the assets go to the right people or to the right causes that you believe in. It'll appoint guardians if you have minor children or if you have dependents. And it can coordinate the estate distribution. So in harmony with your corporate shares or your trusts or your investment accounts, right? You want this thing to be distributed smoothly. To be effective, the will should be professionally drafted by an estate planning lawyer. I don't suggest you use an online template. For high net worth estates, it usually involves complex holdings like a private corporation or holding company or a trust, multiple real estate properties. So this can all require specialized legal language and a strategy to avoid the probate complications or CRA scrutiny. A strong and bulletproof will be reviewed and updated regularly, especially after big life events. So think of marriage, divorce, having kids, selling your business, a major acquisition of maybe like a new property, changes to the business structure. So all of those things, you want to update your will. You also want your will to be aligned with your corporate planning. So you could have multiple wills, say, in Ontario or BC, and you could have a personal will and a corporate will. So you want to have these things clearly laid out. And also you want to have your will backed by clear documentation and clear communication so that the executor and your family know what's in the will, why you put it there, and there's no uncertainty. Step 2, you want to appoint the right executor and the right power of attorney to protect your legacy while you're alive and when you're gone. So appointing the right executor and the right power of attorney is a critical part of a comprehensive estate plan, especially if you've got any sort of net worth. If you're incorporated and you've got a business, or if you've got a more complex situation, you own multiple properties, or you own a bunch of things that need to be managed. The executor is the person that's legally responsible for carrying out the instructions in your will. So this includes everything from settling your debts, filing your final tax return, distributing the assets to the beneficiaries, potentially managing or selling your business holdings. And it's a big job, and it's not one that you just assign lightly. So when you want to choose your executor, it's important that you want to pick someone who's trustworthy and reliable. They will be managing your estate, possibly for months and maybe even years. You want somebody who's financially literate, especially if the estate includes corporate shares or real estate or investment portfolios or life insurance policies. You need somebody who understands what this stuff is, somebody who's good at money. You need somebody who's reasonably impartial. So ideally someone who can act without an emotional bias or a conflict with the other beneficiaries. And you need somebody who's willing and able to do it. Executors can decline the role, so it's critical to have their consent and also a backup that's written in your will just in case. For more complex estates, many Canadians will also appoint a professional executor. So this could be a lawyer or an accountant, a trust company, and there's professional executor companies usually associated with trust companies. So these are neutral, experienced parties who've done this a lot of times to oversee the estate. It can also, like a good reason to do this too, is to avoid family conflict because you're using a professional to do this, and it can ensure a smoother probate process because they know what to do. But estate planning doesn't just begin when you die. There's other documents that you need, and this is where a power of attorney comes in. This gives somebody legal authority to act on your behalf while you're still alive, but unable to make decisions. So you should appoint a power of attorney for properties to help to manage your finances, your corporate decisions, your banking, your investments, if something happens to you and you can't do it. So say you become incapacitated. You can have a power of attorney for personal care. And so in Canada, this would be called a representation agreement, and this can help other people to make medical and health-related decisions for you, so if you're unable to do so. So without these documents in place, your family may need to apply to a court for guardianship or for a trustee authority. So this causes delays, it causes extra expenses, it causes potential disputes at stressful time, and you don't want to do that. So when you get your paperwork together, you want to have a will, you want to have a power of attorney, and you want to have a representation agreement. Those usually come as a package, and when you talk to an estate planning lawyer, they're usually going to put those three things together for you to manage all of that. When you die, if you can't make financial decisions, and if you can't make health decisions. Now, the third step here is you want to use trusts to protect your assets and to minimize tax and to control the distribution of your assets. So for many high net worth Canadians, especially if you're incorporated, or if you're a real estate investor, a trust can be one of the most powerful estate planning tools that's available. And it's not just about passing on the wealth, it's about doing it with control, with privacy, and with tax efficiency. So what is a trust? So in Canada, a trust is a legal arrangement where one party, the trustee, holds and manages assets for the benefits of another party, which would be called the beneficiary. So it can be created during your lifetime. And so there it's called an inter vivos trust, or the trust can be triggered when you pass away, which is called a testamentary trust. And then here's how incorporating a trust into your estate plan can help to safeguard your legacy. So number one is it can control the distribution of your wealth to your heirs and to your beneficiaries. So one of the most common reasons that clients use a trust is to control how and when their children or their beneficiaries would receive an inheritance. So rather than giving an 18 or 19-year-old a giant lump sum of hundreds of thousands or millions of dollars, which is usually the default under provisional intestacy laws, a trust can allow you to stagger those distribution over time. So maybe they get a portion when they're 18, a portion when they're 25, a portion when they're 30, a portion when they're 35. So this helps to protect young beneficiaries from mismanaging large sums of money. It can also help avoid probate, and it can help to maintain privacy. So the assets that are placed in a properly structured trust can bypass probate, which not only speeds up the transfer, but it keeps your financial affairs private and out of the public record. So depending on your province, but here in BC, probate fees can be significant. And so this alone can save your estate tens of thousands of dollars if you need to do this. It can also protect assets from lawsuits and from relationship breakdowns. Trusts can provide creditor protection, and it can keep inherited assets safe from claims during a divorce or a legal action or a business lawsuit. Especially, again, this is valuable for professionals, for entrepreneurs, and for families that have a blended family dynamic. So, there was a divorce along the way, and maybe this person has kids with another person and this person has kids with another person. And now you have this family blended because they got remarried. This causes big problems when you're distributing the assets from a will. It can also help to reduce taxes through income splitting and deferrals. So a strategic use of a trust can unlock tax benefits. So here's an example, is an inter vivos family trust can allocate income to lower income family members. So this can take advantage of their unused personal tax brackets. A testamentary trust can provide tax deferral and income splitting after death. Though recent tax rule changes mean that proper planning is more essential than ever. So at Safe Pacific, we work closely with your estate lawyer, with your accountant, with your tax advisors to identify the right structure, the right trust structure for your situation. Whether you're setting up a family trust or a joint partner trust or a Henson trust or a spousal trust, there's all sorts of ones to do, and you kind of need to set them up right. Step 4 is you really want to minimize taxes and maximize your legacy. So this comes with insurance-based estate planning. One of the most powerful and overlooked estate planning strategies for high-income Canadians is the strategic use of permanent life insurance policies, specifically a participating whole life insurance policy. So unlike a term insurance policy, which only pays out if you pass away during that period, the whole life policy is designed to last for your lifetime. It can build up guaranteed cash values inside, and it pays out a tax-free death benefit when you pass away. So when it's structured properly, it can become one of the most efficient tools for estate transfer and tax minimization in Canada. And it can cover estate taxes with the tax-free payout. So when you pass away, your estate could face a substantial capital gains tax liability, especially if you hold appreciating assets like a business or real estate or non-registered investments. Your heirs could be forced to liquidate assets or take on debt just to cover the tax bill. So a whole life policy creates an immediate tax-free death benefit that can be used to pay those liabilities. And this can ensure that your heirs receive the full value of the estate without delay, without fire selling real estate properties, and without stress. And now that whole life policy that I've talked about, there's a few different ways you could have it. You could have it owned in your corporation. You could own it personally. You could have the estate be the beneficiary so that the estate can pay the taxes. You could have your kids be the beneficiaries. There's all sorts of different things that you can do. And again, that's why you want to work with a professional that really understands your situation so that you set it up in the right way so it does the things that you want. It also can create liquidity outside of probate. So unlike many other estate assets, life insurance bypasses probate. And so that means that there's no delays in distribution. So most insurance companies will pay out a death benefit claim within 2 weeks of receiving the death certificate. There's no probate fees because the insurance doesn't go through probate. And there's no public record of the transaction. So a lot of people really like this. So when you have your will and you pass away and your will goes through probate, it goes through the courts and becomes a court document and becomes public. So anybody can go and search wills of people who have died. And you pay the fee at the court and you can go and look it up. So some people don't want everybody to know who received what. Life insurance pays out privately to whoever is the beneficiary on that insurance policy. So there's a huge privacy benefit to getting a death benefit from a life insurance policy. And your beneficiaries receive the funds quickly, efficiently, and privately. You also get the huge benefit if you're doing this corporately. You get the tax-free flow through the capital dividend account. So this is where things get more powerful for incorporated people. So if you have a business or an incorporated professional, when your corporation owns the life insurance policy, the death benefit, when it pays out, it creates a capital dividend account or a CDA. And then this CDA can pay out to your beneficiaries of the corporation, which would usually be your family members, or maybe you have business partners. and they can pay that out mostly tax-free depending on how much it credits to the CDA. But if you've had the insurance policy for a while, probably almost all of it is going to go tax-free to whoever that corporation's beneficiaries are through the CDA or the capital dividend account. And this makes corporately owned insurance one of the only tools in Canada that converts taxable corporate money into a tax-free personal payout, which is huge and can save hundreds of thousands or millions of dollars in tax. And then another huge benefit actually is you can use corporate dollars to fund that policy. So if you're like our clients, you have retained earnings or you have what they call surplus cash sitting in the corporation. So rather than leaving that cash exposed to passive income rules, passive income tax, which could be over 50% depending on your province, you could redirect that into a participating whole life policy, which will shelter the funds, but it'll also grow them on a tax-deferred basis inside the policy, and it'll provide access to the cash value through tax-free loans, whether you have a policy loan or a collateral loan that you can use during your lifetime. And then eventually it creates that guaranteed legacy for your family or for charitable causes or for your business partners or whoever you want. And this is what we specialize in. So I'd say Pacific, we design these insurance-based estate strategies. We work with a ton of different types of professionals: dentists, doctors, incorporated professionals, entrepreneurs with holding companies, real estate investors, real estate developers, and then families that have complex intergenerational planning needs. And then we work with all the leading Canadian insurance carriers. So any company that you know that has life in the name: Equitable Life, Manulife, Canada Life, Sun Life. There's over 20 of them that we work with. So what we do is we'll find the best one that fits with your situation, the best fit policy for your goals. And then we can structure it, whether that's you're holding it personally, whether it's paying out to the estate, whether it's in your corporation, for maximum tax efficiency and so that it achieves what you say you want as your goals. So whether you're looking to reduce the taxes on death, or you're funding a generational legacy, or it's just simply to get more money and more value out of your corporate surplus or your retained earnings, this insurance-based estate planning can help you do it in a tax-free manner and quickly, guaranteed, and privately. So those are huge advantages that are really not available in a lot of other types of financial vehicles. The fifth thing you want to do is you want to use joint ownership strategically to simplify your estate transfer. For Canadian business owners, for professionals, and for retirees, joint ownership with a right of survivorship can be a practical estate planning tool, but it needs to be used with precision and with caution. When it's structured properly, joint ownership can help you to avoid certain things like probate. It can speed up the transfer of asset. It can minimize estate admin costs. But if used improperly, it can create legal complications. It can trigger tax issues, and it can cause unintended family disputes. So what is it? What is joint ownership with a right of survivorship? This means that two or more people legally share ownership of an asset. So it could be a bank account or a real estate property or an investment portfolio. And then when it includes a right of survivorship, the ownership automatically passes to the surviving owner on death of the other one. So this bypasses probate. It reduces delays. It reduces legal costs associated with the estates. And so this is often, you'll find this with married couples. It's a simple way and it's an efficient way to transfer assets privately and quickly without having to go through the court. So if it's passing from husband and wife to wife and husband or to spouse and spouse, you could have joint bank accounts, which would be used for your day-to-day household finances, the family home or vacation properties, non-registered investment accounts, or vehicles, or other types of jointly held personal use assets. Now, when does this become risky, this joint ownership? It's not a one-size-fits-all solution. And when it's used outside of a spousal relationship, especially if it's like with adult children or other non-spouse relatives, it can have unintended tax consequences like attribution of income. You could have legal challenges from other heirs or other siblings. They could have creditor exposure if the joint owner has their own financial or legal problems. And you could lose control of the asset during your lifetime. So for example, adding an adult child to your house title or to an investment account might seem like a smart probate avoidance tactic, but it could expose that asset to family law claims if in the event of a divorce, or it could cause capital gains attribution when the child doesn't contribute to the asset. So you want to be careful when you have this joint ownership with right of survivorship. The sixth thing you want to do is to keep an updated net worth statement to simplify your estate plan. This is super important. It's not that hard, and most people don't do it. The strong estate plan isn't just about the wills and the legal documents and naming executors. It's also about having a clear and current picture of your financial situation. And so this is why maintaining an up-to-date net worth statement is one of the most powerful things you can do in long-term wealth planning. So whether you're an incorporated business owner, a real estate investor, lawyer, dentist, whatever, a detailed net worth statement can bring clarity. It can simplify your future decisions, and it can ensure that your estate plan accurately reflects your evolving financial life, right? If you wrote a net worth statement 7 years ago, well, it's probably out of date, and it's probably not the same if you update it today. Now, what is it? What is a net worth statement? This is a snapshot of your overall financial position. It's got all your assets, all your liabilities, all the things you own, all the structures, so that you and your advisors can easily see what you own, what you owe, how it's held. So if you're a higher income Canadian or you're incorporated, a comprehensive net worth statement would include things like your corporate structure. So your operating company, your holding company, a trust, your percentage ownership in those things. It could include details about your retained earnings or your passive investments that are inside the corporation. It can include details about your real estate holdings, whether that's residential, rental, commercial properties. It could have ownership titles, appraised values, all your registered accounts, your RRSPs, TFSAs, RESPs, your RIFs, and have the up-to-date balances in all of those. And you want the same thing for your non-registered accounts. If you've got brokerage accounts and your stock trading accounts or GICs that you hold at a bank somewhere. You also want the values of your insurance policies. So if you have any whole life policies, what are the values? If you have any term life policies, what's it worth? When did you start it? When does it expire? If you have any critical illness coverage, any types of insurance that has cash values, you want to list all the beneficiaries. You want to have the ownership details, liabilities, your mortgages, lines of credits, any shareholder loans, any corporate debts, any credit cards, and then any beneficiary designations for all of those accounts, any joint ownership details for all of those accounts. And that, sounds complex, but if you just make a list and just start filling it out, you can help to build yourself a net worth statement that's up to date. And now, why does this matter? Like, why are you going to go do all this work? When your financial records are disorganized or if they're incomplete, your family and your executor are going to face delays and confusion and potential tax risks and potential market risks. Maybe you didn't list a certain stock and it tanks after you pass away. Not a good scene. So an updated net worth statement can simplify your estate administration by making the assets and the liabilities very easy to locate. It can ensure that your insurance coverage and that your beneficiary designations align with your estate goals, and especially if they need to be updated. It can help to identify gaps in your planning, like unused capital gains exemptions or uncovered liabilities. It can keep your estate lawyer and your accountant and your financial advisor aligned when they're structuring a trust or they have a tax strategy or there's a shareholder agreement. And it can serve as a foundation for the business succession planning or for an intergenerational wealth transfer. And then the last thing you want to do is you want to review and update your estate plan regularly. I can't stress this enough. I'm going to say it again. You want to review and update your estate plan regularly. The estate planning is not set it and forget it. Life evolves, your finances evolves, your family situation evolves, Canadian tax laws evolve. All of these things can shift dramatically over time. And that's why it's critical to review and to update your estate plan on a regular basis to make sure that it continues to protect your wealth, that it reflects your current wishes, and that it delivers tax-efficient outcomes for your beneficiaries. We would recommend, just as a default, that you're updating your will every 3 to 5 years. But really, like I said earlier, you want to update it when you have these major life milestone events or like a big financial thing happens. So you got married, you got divorced, you had kids, you bought a house, you sold a house, you bought a business, you sold a business, you won the lotto. All of these kind of big things, you want to update your will because these things make significant changes. Estate planning, it should be an active part of your financial strategy. This is not a one-time event. So, like I just said, we recommend to review this at least every 3 years And for sure, following any significant life financial milestone events. And then again, like here's some common triggers that should prompt an estate planning review. So you sold your business or you're succeeding your business. So selling it or transitioning it to family, all the shareholders agreements, the insurance policies, the tax strategies, these all need to be updated to reflect your exit and to manage your capital gains or your income splitting opportunities. Major asset purchases or sales as well. So if you're buying investment real estate or you're adding a new corporate holding or you're buying private equity, your net worth statement will be adjusted. Your trusts should be adjusted. Your will should be adjusted to reflect this new ownership and potential tax exposure. Any family changes, new kids, grandkids, marriages, divorces, death in the family, all of these will have implications on your will, on your powers of attorneys, on your beneficiary designations, on your representation agreements. So these all need to be reviewed to ensure that the assets pass to the right people in the right way at the right time. And then changes to tax laws and estate legislation. Canadian tax laws and rules are not static. Potential increase in capital gains inclusion rate just happened a couple years ago. Changes to probate rules, adjustments to trust taxation. All of these will dramatically alter your estate outcomes. So staying proactive ensures that you're always ahead of these shifts. And then changes to your goals. Maybe you want to start giving more to charity, or you want to retire earlier. You want to relocate to a different province or country. You want to set up a legacy fund for your grandkids. Your plan should evolve as your lifestyle evolves and as your priorities changed. This video is getting rather long, so I'm going to wrap it up. Some final thoughts is, number one is your legacy deserves more than just a guess. You need to have a plan. You worked hard to build your business. You worked hard to invest wisely. You worked hard to provide for your family. Without a proper estate plan in place, much of that wealth could be lost to unnecessary tax, unnecessary legal fees, delays, family dispute. Nobody wants this. The estate planning is not just about who gets what, it's about protecting your life's work. So with the right strategy, you could shield your family from costly probate, from the CRA getting their hands all over your money. You can transfer the wealth efficiently. You can transfer the wealth tax smart. You can transfer the wealth privately. You can keep your business or your real estate portfolio intact for future generations. You can ensure that your values, not just your money, lives on through an intentional legacy plan. So we help Canadians do this all the time. Obviously, we're not lawyers. We don't write the will, but we can help you put together the structure of what needs to go into it so that you can talk to a lawyer and get it done. And we can introduce you to lawyers that we work with all the time to get wills written. But especially if you're a business owner, if you're incorporated, if you're an investor, if you've got real estate, you want to design estate strategies that do more than just divide the assets. You want to have, like a blueprint to preserve your wealth. You want to avoid the conflict inside the family. You want to make sure that everyone's invited to Christmas dinner, right? You don't want money to blow these things up. And then now all of a sudden you've got these conflicts in the family that could have been prevented with proper paperwork. And you want to make sure that your generational impact is as big as it can be. And really it's more than just the paperwork. The paperwork is how it happens, but what it gives you is the peace of mind. If you want help with this, if you want help with putting together your estate plan, and if you haven't reviewed your estate plan recently, or if you don't have an estate plan in the first place, I'm happy to help put something together. So what you want to do, go to our website. It's called safepacific.com. On that site, there's so many buttons that you can click. You can schedule a free consultation with us. On our contact page, there's a form you could fill out. You can send us a message. Those will come to me. Somebody on the team will reply to you in 24 hours and we can set up a time to meet and talk about your situation. But really, your next step right now is to go to the website, safepacific.com, click on one of the buttons that help you book a meeting with us, and we can take next steps to get this set up. Now, if this video helped you, if you learned something, if you're thinking differently about protecting your wealth, please do me a big favor. I don't ask a lot, but if you could just push that button, the button that says like, the button that says subscribe, the little notification bell. If you have any questions, you can leave a comment under the video. All of these things help the algorithm to find more people like you. This is important information that not enough people have. They don't teach this in school. And really, the only way that more entrepreneurs and successful business owners like you are going to see this is by these messages getting out to them. And hopefully you're sharing it with your friends and family. So that's it for me today. I'll see you next time.